not one, two new ideas with Jeff Marks here to explain why these two are for now. We know you love to hear our introductions, and introductions take time, so I'm not going to dally here. I do have to point out that now more than ever, it is important to try to stay long, to ignore the sirens like the semiconductor top story I saw last night, or inclinations that the bull is tired after 2 years of running. The fact is that inflation is in gentle decline, while rates are too restrictive. There's just too much money made doing nothing. And while employment is robust, it will almost certainly be less robust if the Fed doesn't follow up with more rate cuts in time. The battle right now will be to stay long, just have enough cash in the market, not out, but in, to handle this moment and profit from the retreats like we had yesterday in the wake of that heinous ASML quarter. It doesn't matter what the cautious bulls, by the way, who are really bears in disguise, say. We are in what can only be described as broken field running moment, where the companies that need lower rates or do better with lower rates will shine. The others, holding pattern at best, unless they have secular tailwinds, how much I like those. The good news is that there are so many companies that benefit from lower rates that we just need to figure out who benefits the most. The great news is that we have the best secular tailwinds in this entire market in our portfolio. We have some real good stocks. Club members, I hope you participated in the Abbott and the Morgan Stanley quarters. Wow. Good day for us, isn't it? Let's start right there with a discussion of the rocket fuel that is lower rates as we review the portfolio with the Fed in mind. The most significant beneficiary in the entire trust is Stanley Black & Decker, because lower rates means more homes for sale and lower rates means more renovation using home equity loans. It's not easy to try to figure out what will cure the housing crisis. By the way, higher mortgage rates this month don't help. But something brought out by the incredibly low rates that translated into 3% mortgages that the Fed felt was needed to save the economy from COVID now is the enemy. With lower rates coming, the possibility of people getting a mortgage that isn't all that much higher than the one they took down during COVID isn't going to be beyond the realm. That's why I think that this stock, Stanley Black & Decker, has so much further to go. You might want to fix your house up to sell it. You might want to fix up your house that you want to live in but didn't want to get too indebted. All this will come to play with this company, which has become a potential upside surprise earner next year. Oh, by the way, still yields 3%. Those low HELOC, as we call them, home equity loans, can really be great for them. Second, Best Buy. Best Buy, we know that the big money at Best Buy is made with big tickets and then secondarily with electronics. The appliance sales Best Buy had last week, timed, of course, with Amazon's Prime, were so strong that I think it could produce some real needle movers. And while PC sales aren't as strong as I would have hoped by now, I know that Micron's Sanjay Mehrotra told me that 2025 is shaping up to be very, very big. So first appliances, then PCs, to me says Best Buy could be a remarkable rate beneficiary for some time. Oh, and it yields 3.85. Home Depot would be good enough if it were just for the rates, but the rebuild from these storms would be gigantic. Now, we don't want to dwell too much on profiting from the weather. There's too much human destruction. But when you see that the federal money is rolling in, of course, the insurance money too, you would be hard-pressed to find a bigger beneficiary than Home Depot. And I've done a lot of studying on this over the course of the last 40 years. As far as rates, the thing you need to know is that shoppers shop Home Depot when they think their home is improving in value. It's capital appreciation, not repair. And that's been the case forever. We just have been waiting for a little interest rate normalization for home equity loans to make it more attractive to put more money in your home, especially if you want to sell it. The stock can really gallop from here, as I expect it to be considered the number one retailer of the entire S&P 500 when it comes to lowering rates, and I'm proud that we have it. Morgan Stanley, we got a real interesting story developing as the company highlighted lower rates as a major reason for the stunning upside surprise. Here we go, just one moment, up $8. The trading and investment banking revenues were terrific. They reported the largest year-over-year increase in markets and investment banking fees in the group. Wealth management margins were amazing. It's a big catch-up to the group. Make no mistake about it, though. This is a lower interest rate play, and we are going to hold on to this one. Oh, and it yields 3%. How about Wells? All right, I don't know if you caught my interview last night with Charlie Sharp. But, man, he's fantastic. He's the CEO of Wells Fargo, but he is positioning his bank to take care of what he thinks is a very good moment for business, who, no matter who is in the White House. So that was an important point. What's even better, when you hear that rates may not come down as fast as some commentator or hedge fund bear wants it to, please remember that Charlie has positioned the bank perfectly to make the most money in a higher for longer scenario. That's why it is not done going higher. Here's a tricky one, and one that befuddled us for some time until we really got down to the nitty gritty. It's called GE Healthcare. When we bought GE Healthcare, we did so, frankly, because we thought that once it got out from under the GE umbrella, it could thrive. That was wrong. I screwed up. Nothing's really changed. Well, you could say they screwed up, but since we bought the stock, we screwed up. Now, why has it not come back? Because China fell apart for them, raw costs soared, and it became too expensive for institutions to borrow to buy their equipment. Equipment's very expensive. Plus, the company is too early in trumpeting its AI possibilities. Haven't we seen that with a lot of companies? And didn't have a game plan for default if all these things went wrong, which they did. Now, finally, it's all coming together domestically. And if China comes on, even better. I think the last quarter was the bottom. GE sold down enough of their own stock. I'm not worried about any overhang up here because we haven't seen the estimate bumps yet for 2025. We don't know if the stock is inexpensive enough to punch through 100. But I think it's a high-quality med tech company that can go up over time. That's not overnight, over time. But lower rates do accelerate the story. Oh, man, I got a couple of stinkers in a row here. I'm going right to it. Jeff knows I complain about this constantly. I complain about Nextracker. It involves enough financing that it can be considered a rate beneficiary, of course. Now, I am indeed furious at myself for actually thinking that all that mattered would be the desire for companies to get more kilowatts out of solar. There's always more to solar than that. And I bit because I thought any company that could be big in countries that don't get a lot of sun would be huge in those that do. But a lot of the solar projects involve timing issues, and others involve infrastructure funds. And the next, of course, and who is elected president. And the next thing you know, a company you like because it had terrific tech, you dislike because it doesn't have control over much of its destiny. Stock trades horribly, as if something really terrible is lurking. A couple of notes today backed it up. Maybe I'm wrong. I hope I'm wrong. But we have been reluctant to buy more because we don't have the conviction needed, given how horrendous the stock has been and how this company has completely overpromised and then substantially underdelivered. It is a wait-and-see situation that I am clearly concerned about, if not angry, and not in a good way, obviously. Lower rates should help it. All right, now here's one that is, look, I like to give you the tough ones and the good ones, the ones that are working out and the ones that are works in progress, Constellation Brands. Not until Bill Newland, CEO of Constellation, came on Mad Money and explained how important the Hispanic employment rate is to Modelo and Corona sales. I didn't realize that. Holy cow. This one's a rate play too. Look, I think that most consumer packaged goods companies are more recession-proof ideas than anything else. Not here. This turns out to be an Hispanic growth story that could admittedly go down further if Trump wins. But I am beginning to believe it reflects that win. And if the nation votes in favor of Harris, both this and the befuddling Nextracker will go higher. Still, it's not the important thing in this case. As we said when we bought some earlier in the week, hope you got that bulletin. This story is about cash flow and buybacks, but it sure does have an employment kicker. Here's one that people don't think of as about a rate play. They're wrong. TJX. Now, see, TJX is not an aspirational shop experience. It's basic. I know. Look, I love my TJX. It's down the block from me. But I have no illusions. I would presume that a big percentage of TJX's customers buy on what my folks used to call on time, meaning they borrow money. Business is very good here, but it will only get better. And in the meantime, the stock is way down from its highs. I think that it, like many of our stocks, is at a price where I hope it consolidates before it goes higher. It had been a parabolic mover. Down 6 from the high is a decent place to start if you do not own any TJX. Okay, here's one that people are telling me that the chart's no good. The chart, well, that's a good enough reason to get out of Apple and NVIDIA, so it must be good enough to get out of Costco. All right, you'd be surprised at how much Costco does with small business. That makes I was being facetious. That makes Costco a beneficiary of lower rates. Not that it needs it. The stock is stalled after a very big run, and that's not unusual. If you go look at all the times after special dividend and membership fee boost, it does stall. It's ironic, but the time to buy the stock is now. Historically, there's just this moment. There are no speculators in it, hoping to I think that they're trying to time their buys with the dividend and the membership boost. Those people are gone. This is an excellent level to start a position with the idea that if we get some higher for longer headline, you can buy more. Be mindful the stock is a tough trader, hence why I think that the chartists are scared here. That's because it hasn't split. It's trading in 10-point increments. If that's not unusual, you have to, if you just joined the club and you're trying to buy 10 shares of Costco, buy 2. Buy 2. All right, now, Linde. They've got some cyclicals that should normally be more levered to rates than the old days. But when you look at their makeups, they're decidedly far less cyclical than you think. Still, when you take a company like Linde, which has made all of its profits through pricing, in other words, raising the price of industrial gases, not the volume, you have to wonder whether it could be a very big rate beneficiary when volumes pick up. What a remarkable company that its business never faltered. Isn't it something? But I get it. My wife and I have an agrotourism villa that she runs in Tuscany. She grows grapes. Really pretty good stuff, actually. We are very lucky to have such a place. Before I came back from Italy recently, we visited our vintner, who was a couple of miles from our house. And I saw, hey, you have carbonation. What kind of carbonation are you using? I asked him where he got it. And he rolled his eyebrows and said, Linde. Although he said it kind of more Italian. I won't try to imitate that. He said, Linde's the only game in town. That's how it almost always is with this company, the only game in town. Oligopolistic pricing, even in Tuscany for all this. Boy, Tuscany's got the super Tuscans. You need Linde. Maybe that's why they have so much pricing power. Oligopolistic pricing. Now, we got pleasantly surprised as we spoke to you last with Honeywell. So the question is, now that it's getting rid of a one division, will Honeywell do better with lower rates? As much as it might encourage some economic activity when it comes to climate control, also known as energy and sustainability solutions, or industrial automation, it's saying goodbye to the companies that made up the old Allied Chemical. That's great here. That was one of the largest companies in the world at one time. But like many chemical companies, it just stopped growing unless there was a boom. So when you get less cyclical, you care a heck of a lot less about the Federal Reserve. The stock, after a great run from the breakup announcement, is up about 4% for the year versus Eaton up 41%, Dover up 25%. So I'm not itching to sell any of this one. Let's wait until we see some of the benefits of the spinoff, for heaven's sake. Oh, Eaton, Dover, and DuPont all pretty much have a degree of cyclicality. But DuPont's the most levered to the cycle because DuPont is happy to split into three companies, but would, I think, field bids for its divisions, especially the water business, which is a nice non-cyclical enterprise, could really help Xylem or Pentair have more scale. They would need to borrow money, hence the leverage, hence the worry, hence the fit. Lower rates and DuPont, Dover, and, well, let's just put it this way. They all claim the clean earth mantle. I think that in the end, Eaton is an electrical company in an era where the grid is so badly in need of refurbishment and improvement that it is difficult to imagine a more perfectly positioned old cyclical. Dover's got pumps and processing, but the rest of its business, like so many other one-time cyclical businesses, is now levered to clean energy, including, yes, connection to the data center. These companies didn't do as poorly as you would have expected when rates went up. So frankly, I therefore can't expect them to do all that much better as rates go down. That's really about as far as it goes, by the way, when it comes to the benefits of rates for our companies. It's not that we deliberately set up a portfolio that avoids rate exposure. It's just that we prefer companies to be more in charge of their own destiny than others. And that means they don't want to be hostage to something they can't control, the cost of borrowed money. Let's go over the others with a little less emphasis on the Fed. Let's consider the non-techs, non-healthcare companies that we own. Why don't we start with Starbucks, which was bulled today by an analyst. Let's take a look at that, see whether it mattered in real time. Starbucks. Didn't work. I knew it. I knew it wouldn't have worked. We've owned Starbucks for a while and built up a nice position into the COVID pandemic. We left it, and then we came back to it when we felt it had come down enough, and we had such faith in the previous CEO because he seemed to know so much more about how to take the company to the next level. He was wrong. We were wrong. Anyway, we got bailed out by the board's pick of Brian Niccol. We don't know his strategy yet. We know that he's wedded to execution, though. But unlike the franchise company, Starbucks owns most of its stores, much more like the Chipotle model that Niccol's familiar with. Rates really don't impact the company, but I do think that certainly the execution is good. By the way, if you don't own it, let it drift down. Let it drift down to 87. Could do that. It had such a big move where it would yield almost 3%. God, there's always a stinker in the garden party, and the stinker today is Danaher. Now, Danaher is levered to the capital markets, okay? It needs young biotechs to get capital to create life science companies that have lots of trials so they can become the next big thing. As was the case many years ago with Amgen and then Regeneron, well, you go buy equipment. In this case, you would buy it from Danaher. You could argue that once they get that capital, they need to borrow money to buy life science machines from these guys. But that's awfully attenuated. Suffice it to say that the stock won't get to 300 without an equity market that can support lots of life sciences IPOs. And we do not right now have that equity market. But Danaher is being revalued upward, and I really like it. How about Disney? All right, well, look, Disney might have to tap the bond market. That could be rate sensitive to raise the money it needs to pay Comcast for its 33% stake in Hulu. I had originally thought that might come down to about $10 billion. It's looking, but it's looking somehow like it might be more than that. At the same time, you could argue that Disney needs lower rates to make people feel better, so to speak, about spending. Yeah, that would make it so Florida's doing better. Florida's not right now. I think it's a kind of a bogus assumption, frankly. What will drive Disney stock higher is if it can produce some sort of long-term growth path, which includes something besides the darn movies and ESPN. It needs to build more theme parks. It needs to announce that. It needs to execute. It's doing that, by the way, with ships, thank heavens. Theme parks make money, and of course, they can't be poached. They can't be marginalized or commoditized. But the company is focused on trying to figure out what's next, even as I think that theme parks are the hub, not the movies, not TV. Why do we own it? Because I think that it has a tremendous business that is coming back, just not as fast as we would like. I am counseling patients because while there is no truly visible magic bullet here, things are gradually getting better, as I said this morning on Squawk on the Street. If I knew there was something growing better that was cheaper, believe me, I'd make that choice. We would both from Disney. I just don't have anything. And this one, geez, if we're to fall below 90, it'd be a godsend. I want to buy more. By the way, I've made my peace with Iger. I like the CFO, Hugh Johnson. They think they will figure it out. All right, here's one that I just count my lucky stars that we did not buy more of another company in the industry. Yes, I'm talking about Coterra. These days, all I can say is that one day we are going to wake up and see this stock at $40. Perhaps in the same way we saw Pioneer PXD through a bid. That was the Exxon bid. Right now, there really isn't all that much that relates it to rates. It's levered to nat gas, which is levered to supply, not demand, which means the stock should be bought under 25. We are waiting. We are thankful that this is the only oil we own. I particularly want to thank Jeff, who, when I would say, how about EOG? How about maybe this is the time to take a hard look at Diamondback Energy? I had the good sense to say, yeah, keep looking. All right, now the drugs. Lilly and Abbott. Lilly is all GLP-1, even as I was hoping there could be a component involving Alzheimer's, because I believe its drug really does work in delaying onset. But Lilly's not putting big dollars behind it yet, and I think that's wise. It's a GLP-1 company with a lot of moats, and it's going to stay powerful one way or another. I really like it. We need to see trials showing how beneficial this drug will be for Alzheimer's. We don't have enough yet. We have one, obviously, to get an approval, but we need more than that. There's no economic sensitivity here. It needs more studies on Alzheimer's to get the coverage, which is the name of the game with these expensive drugs. Now, here's a great one. Abbott. They just reported a terrific number with a huge buyback, more than $7 billion, and it's driving the stock higher. Right now, we are simply waiting for the lawsuits involving special formula for premature infants that the plaintiffs are trying to link to a life-threatening illness, something that the FDA, the NIH, and the CDC have finally come out and said, no, they can't prove that there is a linkage. Now, I think it will all be cleared up soon. I think that we will focus more on its incredibly fast-growing diabetes, glucose monitoring, diagnostics business, both of which are doing incredibly well. I really like this story, but I don't want anyone buying any more up here until we hear this last bad verdict that I told you I expect in St. Louis. Why am I sure it'll be bad? Because get this, the judge unfathomably will not let the joint statement from the NIH, FDA, and CDC in the courtroom for evidence. How can that be fair? After that, it's so infuriating, and the Abbott people feel incredibly aggrieved to, and they're good people. I really like it. All right, now, after that, it's all tech here. So let's tackle them on their own merits. I'm not going to spend a lot of time on them because you know them. But first, the companies related most heavily to artificial intelligence, NVIDIA, AMD, and Broadcom. I don't have much more to add to the NVIDIA story other than it can't make its products fast enough, high-quality problem. And there is enough software in them now that the moat just keeps growing and growing and growing. AMD is a distant number two in a business that, frankly, needs more than one, right? They're number two. I think that it's a travesty that this stock has done nothing this year, even as Lisa Su, CEO, keeps raising her sights on how much AI business there is. Broadcom, what can I say? It has AI, it has data center, both strong, it has PC, cell phone, both weak, but getting stronger. I really like all three right here. I really like that many TV shows and articles are calling the top in semis because of the ASML, that semiconductor capital equipment company. We need more worry. It got too complacent. People aren't complacent right now, though. That's positive. How about Salesforce? All right, there's the best. That's the best AI non-hardware play I know. Salesforce.com, which is about to set the world on fire with this agent force, the first real use case for AI that allows it to replace humans so they can do more important things, more productivity. I envision all of us one day, when offered the choice between speaking to a human and a virtual agent, is going to go for the agent, who'll be more empathetic, kind, less harried, and yes, more authoritative, with a really good memory. Salesforce can set up these virtual agents for you. Agentforce is why this stock has had such a huge move. How about Palo Alto? All right. Speaking of huge moves, we've been rewarded for our patience here and sticking with it and buying more Palo Alto when it came down. Well, I would have thought that Palo Alto would have taken more business from CrowdStrike. A little more on that in a second. The cloud native company just has a very good position when it comes to companies that have migrated already to the cloud, better than Palo Alto. But there is room for both. It's the fastest growing sector away from generative AI in the entire stock market with monster tailwinds. Now, I don't want to spend too much time on Apple. Some clown that said it's not doing that well today. Some evidence lab. The guy should be like an NCIS. He's like one of those CBS shows, I think that Alphabet, Amazon, Meta, and Microsoft are all doing well. The Apple story is one of elongated cycles and should not be, we don't want to rush it. That would be wrong. The endless downbeat stories about how it is going to miss the quarter, enough already. It's not about the quarter. It's about the AI rollout and how Apple's going to be ready when you are really nice. You had a really nice move yesterday, despite the semi-sell-off. Alphabet's my least favorite because if Harris wins and she keeps the same crew of dolts, you get the wrong judge, this will have a rough time. Why not sell it all? Because if we get the right people in antitrust, it will zoom. I don't know why people are so worried about Microsoft. That was, another ill-advised piece this morning. The AI Copilot has lost its inclination, fascination with people. I can't be sure of that, but I do know that it's hard to believe that this Microsoft would do anything other than fix it if it's not working. That's the way Satya Nadella does things. By the way, Charlie Scharf told me yesterday, the CEO of Wells Fargo, who was on the board of Microsoft, that their AI is doing incredibly well, and the Copilot is really, really loved. So I trust Charlie more than I trust the analyst who doesn't like it. Meta. The only thing that worries me about Meta is that every single analyst loves it. But after speaking to Shantanu Narayan on Monday about Adobe's new software that is made for video on the web, which therefore means it's made for Instagram, I felt real good. Just one more reason to stay long it. And so we shall. Wow. Okay. I promised that I would finish in 18 minutes and 38 seconds, but it ended up taking 18 minutes and 22 seconds because I need to turn over to my partner, Jeff Marks, who's going to discuss not one, but two initiations to the portfolio. I'm very excited about this. Jeff.
Yeah, we got a lot to work through right here. So why don't we start off with the first one, recently added into the bullpen, BlackRock. So BlackRock is the world's largest asset management largest asset management manager and a leading provider of investment advisor and risk management solutions. It offers a broad set of investment products in equity, fixed income, multi-asset, alternatives, and cash across different client types like institutional, retail, and ETFs. And this is all around the world. About 43% of its base fees come from actively managed products, 42% from ETFs, 8% from index, and 7% from cash. BlackRock reported a strong set of third quarter results last Friday. Total revenues increased 15% year over year to $5.2 billion, thanks to the positive impact of markets on average assets under management, 5% organic base fee growth, and higher performance fees. By the way, that 5% organic base fee growth, that was the highest in the company's highest level in the last 3 years. So nice acceleration there. BlackRock also lived up to its reputation as a premier asset gatherer, generating $221 billion of net inflows in the quarter, a company record. The company is having a huge year through the first 3 quarters of 2024. Net inflows already surpassed the full year net inflows of both 2022 and 2023. Assets under management stood at about $11.5 trillion at the end of the third quarter, up $2.4 trillion year over year. Profitability was another highlight. The company continues to deliver sustained asset and technology service growth at scale while remaining disciplined on expenses. Adjusted operating margins expanded 350 basis points year over year to 45.8%, leading to adjusted earnings per share of $11.46, well above estimates of $10.40. The company also bought back $375 million worth of shares in the quarter, slightly reducing its weighted average diluted shares. The company also pays a dividend yield of about 2%, and it has increased its payout for 15 straight years. Now, one of the company's biggest strategic pushes right now is in alternative strategies like private markets and infrastructure. Earlier this month, BlackRock completed its acquisition of Global Infrastructure Partners, a leading independent infrastructure fund manager. The company believes this combination will, quote, provide clients access to investment and operating expertise across the infrastructure landscape. BlackRock believes infrastructure is a $1 trillion market today and will continue to be one of the fastest growing segments of private markets in the years ahead. The deal brought in an additional $116 billion of client AUM and $70 billion of fee-paying AUM. It also added long-dated, non-redeemable assets to BlackRock's business, which the company likes because it diversifies its revenues and earnings mix. Management believes these private market assets will positively impact the company's overall effective fee rate by about 0.5 to 1 full basis point. The stock has had a big move this year, gaining roughly 24%. It's trading at all-time highs today, but we think the gains can continue. It's a pretty steady business with market-leading organic growth, margin expansion, plus a dividend and buyback. Also, BlackRock should see an acceleration of inflows into fixed income as central banks cut rates, pushing some of the record amount of assets in money markets to flow into bond funds and ETFs. CEO Larry Fink addressed the large cash holdings of investors on the earnings call, explaining that, quote, investors will have to re-risk to meet their long-term return needs, end quote. Fink sees opportunities for investors across several structural trends like rapid advancements in technology and AI, rewiring of globalization, and the unprecedented need for new infrastructure. Fink is a thought leader in the banking industry, so you have to take whatever he says and really take it to heart. So we're going to start this position off on the smaller side, given the stock's recent run to new highs, but we'll take advantage of pullbacks to add to our position. Obviously, the financials have just had an extraordinary move over the last few days. We saw it with Wells, Morgan Stanley today, BlackRock as well.
Yeah, I wanted to just kick myself when I saw BlackRock had that little ramp up today. And I know that some people might think it's a parabolic move. And I know some people might be confused that we just start small. It's not our goal, by the way, to have this go here because then we won't have enough in. But the worst thing in the world would be to be a full position here and then have it go here. I know we have a question in the Q&A about why we started at a certain level. There's nothing you can do. I needed to see the quarter. I needed to speak to Larry Fink. I wanted to be sure that you got the benefit of that analysis that we used for when it was squawk on the street. So even as we wanted to buy it, we did put it in the bullpen. Those who want to be adventuresome, we could have pulled it from the bullpen because we felt that it was going to move too much. But Jeff and I go back and forth and back and forth and back and forth, and we're confident this is not a one-quarter story, and that's how you have to vision it, not a one-quarter story.
Yeah, just very steady business, high quality, everything we like. Yeah, revenue growth, margin expansion with some capital return. All right, so next up is CrowdStrike. CrowdStrike is the cybersecurity company led by its co-founder and CEO, George Kurtz, who Jim has had on Mad Money many times. CrowdStrike specializes in endpoint protection through its AI-native platform called Falcon. The Falcon platform operates entirely in the cloud, allowing for rapid updates, scalability, and ease of deployment. There's a good white paper on CrowdStrike's website published by IDC that explains the value of the CrowdStrike Falcon XDR platform. Obviously, it stops breaches, right? That's what they do. But it also saves time by speeding up threat protection and response while also helping security teams do more with less. It saves money by reducing the cost of cybersecurity. Companies can essentially just get rid of less effective platforms and consolidate point solutions. Now, the IDC report also found that customers realize a $6 return for every $1 invested with a 5-month payback period after they use the Falcon XDR platform. CrowdStrike was virtually unstoppable this year up until July 19th, when a faulty software update to its Falcon sensor security software system caused a global problem with computers running Microsoft Windows. It was a major blow for the cybersecurity company, especially one with a pristine reputation. There was a lot of speculation that these outages would hurt their business from customers essentially revolting, resulting in a loss of market share. However, when CrowdStrike reported at the end of August, the results were excellent. Revenue up 32% year over year, adjusted earnings per share of $1.04 versus the 97-cent consensus. Even better, the company showed a gross retention rate of 98%, a sign that virtually no business was lost from the event.
Amazing.
Yep. Yeah. And more recently, the company held its annual FAL.con conference in September, and it seemed to get a great reception with attendance up 30% versus last year. Microsoft CEO Satya Nadella spoke at the event, which suggested the two companies buried the hatchet. They've had a huge rivalry for years, but ironically, this incident brought them closer together. Shares of CrowdStrike may be up almost 40% since bottoming in early August, but it's still down more than 10% from the July 19th incident and about 23% from its closing high of $392.50 on July 1st. So this could be an opportunity here since virtually no business was lost. And they've virtually, the reputational risk is, they've worked through that. George has worked very close with every single
maybe
customer.
we can just have the chart so I can show you, visualize exactly what Jeff is talking about. Okay, so yes, you would love to pull the trigger when in the trough, but you see in the trough, you didn't know how many clients they had lost. Okay, the belief had been that they would have lost a substantial part. It was not. Remember, it was not it was not a hack. It was a glitch, a computer programming glitch. Now, we have subsequently found out that George has been on a tour of 130 companies in 100 days, okay? This man, by the way, won Le Mans, won Sebring, won Daytona. That's actual.
Very impressive.
Yeah. And so what we're doing is, once again, like BlackRock, we buy some here, and then we hope that the market gives us an opportunity to buy lower. One of the strong things you want to do with your personal portfolio is you always want to be rooting against your stock. If it goes up, high quality prop. If it goes down, you are absolutely ready to build. So that's the way we're approaching. Would I like to have had the vision when I had George on, squawk on the street, when things were absolutely abysmal? Well, what would happen if it turned out that they lost more than Delta? You know what would have happened? We would have bought something at 200 and it would have gone to 100. So I feel a little more certain, but that does not mean we should just sit here, buy it all, and bet the house. That's not our style. It must not be your style.
Yeah. Well, at the same time, the cybersecurity stocks have had a very nice run here.
Yes,
We're in Palo Alto Networks. And so you might be wondering if adding CrowdStrike to the portfolio means that we're heading to the exit door on Palo Alto Networks. Now, does having two cybersecurity companies violate our rules about diversification? We typically don't like to double up in one area, but we think there's room here in the portfolio for both of these best-of-breed names because of position sizing. Right. Palo Alto Networks isn't that big of a position in the portfolio anymore because of all the huge gains we've locked in, and cybersecurity is a great area to be invested in.
Most tailwinds of any area other than generative AI.
Yeah, we're in an elevated threat environment given all the hostilities happening around the world. Artificial intelligence and generative AI have made bad actors even more sophisticated. So corporations need to invest with the leaders in the industry to stay protected. And we're almost a year into the new SEC rules surrounding the disclosure of cybersecurity incidents, and greater awareness around threats has been a tailwind to sales. So we'll have both. We'll manage both. You can definitely like the space. And, with, again, Palo Alto, it's about a 2.5% position in the portfolio. There is room to add another name.
Right. And look, I'm incredibly conscious. We went over and over. Obviously, you could say, Jim, I thought diversification is the hallmark of our portfolio. All right. So let's cover this. There is such a thing as a special situation. George Kurtz is taking a company that would look to be destroyed and is actually making lemonade out of lemons. I do not want to miss that because of diversification, that would be cutting our nose off to spite our faces, because it is this, like I said, there's generative AI, of which, by the way, what can you actually play generative AI? That's Jensen and that's Octane. Okay, there really isn't that much else besides that, frankly. And then we did add, we have Lisa. How do you play cybersecurity? I mean, cybersecurity is probably when you sit down with Charlie Scharf at Wells Fargo, when you sit down with any of the banks, I mean, they're just petrified. They'll spend any amount of money on cybersecurity. So we're going to spend some money. Now, remember what Jeff said. There's two different kinds of diversification. Just, there's name diversification, and then there's dollar amount diversification. We do not have a lot of dollars in cybersecurity. And is cyber the best? Is this the best play? Is CrowdStrike the best play? I would say it's the best level, not necessarily the best play. I mean, it's just, the fact is when people realize how amazingly George has done in keeping clients, it really is rather extraordinary. And even the Delta, I talked to a lot of people who say, what was with Delta? You would think that they would be saying, what's with CrowdStrike? It's what was Delta? Very interesting question. I really, really like it.
Yeah, I mean, look, Palo Alto, it's within an earshot of its all-time high, 376.70 is the all-time high. It's at 370 today. And we just talked about how much CrowdStrike is down. You can just see in the last 3 months there,
Right.
down 17%.
We get bad NASDAQ day for no reason other than the fact that it's in the NASDAQ. You'll see 280, and you'll see us pull the trigger.
All right.
More.
Should we turn to the Q&A now?
Absolutely.
All right.
I'm going to let you start.
Yeah, let's get to the most exciting part of our monthly call, hearing directly from everyone at home. So first up, we have a question from Juliet in Washington, who wants to know, how does Honeywell's spinoff of its materials business benefit current shareholders? And why does the spinoff unlock additional value to shareholders? So the key with the spin, Juliet, is that the argument is that Honeywell should get a higher multiple in the market because it is shedding a slower growing business at about the same margins. It reduces its cyclicality, and the free cash flow capability should improve as well. So based off those attributes, you could argue Honeywell should get a higher multiple. Now, for the spun company, it could be worth more valuable as a standalone company as well, because they can finally pursue their own growth opportunities that are specific to that business. Remember, the CEO of Amul Kapoor is focusing on 3 mega trends: automation, the future of aviation, and the energy transition. So not exactly in alignment this advanced the materials businesses. So if it can pursue its own growth opportunities, you get a better growth outlook and create more value that way. So that's the argument there.
Right, and remember, when I had Vimal on MAD, I got the impression that, look, these are 3 companies that could do what they want. You could put them under one roof, put them under 3 roofs. Obviously, that you don't say that when you start, but it is very clear to me that even though he said there's synergy among them, I'm not that crazy about automation of buildings. That was one of the divisions that wasn't doing that well.
It's been a weak business for them.
It's been a weak business.
They're trying to beef it up with the acquisition they made from Carrier.
Right.
But it's been soft.
And I don't really necessarily want to buy from Dave Gitlin at Carrier because he's so smart, although he needed to sell that division in order to be able to get a better credit rating. So there was a reason away from the fact that it seemed extraneous to him. All right, next up question from Alan, who asked, Jim, what are your stock recommendations for how to play the data center build out? Is this a long-term investment possibility? Oracle says many more data centers are needed. Much is made of the grid's inadequacies and infrastructure equipment needed for centers themselves. Okay, so, Alan, I would say that our picks answer the question. It's hard. I mean, when you go to the Dover, when you go to their annual report, it seems like it's just one part of many, but there actually is a lot in the data center, and it's growing. Obviously, Emerson, which although the rest of the company is a little bit too expensive, we did buy and then sell Emerson not well, but that was because Emerson didn't articulate things correctly.
But we switched it for Eaton,
exactly,
which plays directly into the data center, right, with all their electrical equipment.
And then Vertiv. Vertiv is very, very important to it. That's really a pure play. But what I would emphasize to you is Oracle said, Larry Ellison said he might need 1,000 or 2,000.
Yeah.
Now, that gives what that does is give us a long-term tailwind. Remember, we're not traders. So Eaton and Dover are, to me, still the highly valued of the companies that are connected with the data center.
Yeah, that really reignited the AI trade after he said that. Larry Ellison.
I should have mentioned Cummins has they have the emergency generator. Yeah. Because you can't have these things go down ever.
But as for Eaton, data center, it's about 14% of their revenues in 23, one of their fastest growing businesses. AI data centers, even a bigger tailwind because of they have even more power needs relative to traditional data centers. And Dover as well, we've talked about the liquid cooling part of the business. Remember, Jensen has said that with the Blackwell platform, you can no longer use air cooling. That technology does not work. You have to go with liquid cooling. So that's a nice tailwind for them. All right, so next we have a question from Bill, who asks, when you exited Procter & Gamble, did you do it because of market conditions, thesis changed or underperformance compared to the S&P 500. There was a bunch of different reasons. First off, they didn't have a good quarter before that. A lot of it had to do with China and the beauty market in China, which doesn't look like it's getting any better. The valuation looked expensive, 24 times earnings, a bit of a premium to the market, not a lot of growth. And we just figured the market would favor some more growthier names after the Fed started cutting rates. So maybe a less of a need for a defensive stock. Still a good company, but it had a great move this year. Don't forget that.
Yeah, it did. And I was concerned that we would sit here and say, oh my God, they didn't fix the China problem. The China problem is an investigation. China's a nightmare. I'm tired of hearing that a company that we like very, very much is regarded as being a disappointment because of China. I would have to listen to a Moeller come on, squawk box and say it. And it's like, I just don't want that anymore.
Yeah.
And it was a small time position. We're going to be in much better stocks than that. And so I feel that we did the absolute right thing. I would do it again. Yes. Did we catch the exact top on the sell off? No, but it doesn't matter. We don't want to be down 8. I think you'd be down 8 on that darn thing. And that would be, of course, disappointing. All right. So here's one where Darlene is asking a very interesting question. What are your thoughts on the new regime coming into Eaton? Now, Craig Arnold did a remarkable job, a remarkable job. But I would come back and say that Paolo Steiner is going to do terrific. Season hand. Eaton is a remarkably changed company from the old days when it was, there was a regime. I'm not going to slag the old regime because Sandy Cutler did a good job, but he didn't see a lot of what's come. These guys have a gun that literally shoots around the corner, and it's in their DNA. I'm not at all worried. At one point I said, in the same way, by the way, I mentioned to Jeff this morning, oh, geez, what happens if Larry Fink retires? You always have to think that way. So I want to encourage Darlene to continue to think about the next regime, but I would also come back and say, this is a changed company, and it's not going back. It's going to continue to be on course.
I think it's good to point out that Craig Arnold's retiring because of he's hitting the mandatory officer age, 65. So Paulo Ruiz will succeed him on June 1st. He led the industrial business the last 2 years. You talked about a lot of the changes in the company. I think that's what I'm most interested in hearing in future conference calls is their M&A strategy and just sort of what are they focusing on there in terms of portfolio management. I mean, we were talking today also about how Dover, so much of its business has changed over the last 10 years. Oppenheimer, they raised the price target.
It's hard to keep up on that one.
Pointing out in the last 10 years, over half the revenues are no longer at the company. So really leaning into green energy transition. They sold the ESG business, which was garbage trucks.
I really like
another one.
I really like Dover. I remember it was Dover Elevator. I mean, these guys have so reinvented the company. One by one, analysts find out, and then they then they upgrade it. They cover it, then they upgrade it. Now, Paulo Ruiz, again, now he's been around for a long time, but he doesn't come in until June 1, 2025. Right. So that's plenty of time for the street to get to know.
And he led the industrial part of the business, so not the electrical.
No, it's exactly. If you were coming from outside, I guess I would be a little more concerned. All right. Now,
why don't I take this? And we got a question from Arnell who asks, what percentage of your portfolio should you invest in your first buy, assuming you have high conviction? This is a really good question. We usually start off generally anywhere between 0.5% to 1%. It really depends on, maybe if the oscillator is oversold, maybe we'll go a little bit higher, 1%, or if it just sold off, and it didn't deserve, maybe we lean on the higher end. But we always, as Jim was just explaining it just a few moments ago, we always start off small. We leave room just in case the market goes against us, and so we can buy more on the way down. Sometimes it works, sometimes it doesn't. Home Depot is a good example. We didn't get as much as maybe we wanted. The stock has been straight up since we started buying it. But other times, AMD is a good example. We left room. We're able to, started off a little bit too high, but we're able to get a lot on in the 130s to make up for that. So again, it's about patience and understanding that, yes, you want some exposure, but leave some room to buy more.
Right. When I used to be a trader and I learned from the best, you had to do the opposite. The most important thing was 2 points, timing and catalyst. Buy it perfectly And what's the catalyst? Well, the catalyst is on October 22nd, something's going to happen. So we buy it right now. And we're doing the exact opposite.
Yeah.
We're taking the gun away from your head and mine. That doesn't necessarily mean that we're going to say, wow, why did we start so early? You can second guess what it could have, should have. What it says is that we're trying to build a position at a good price. And it does not help us if the stock goes right up. But we have to do this because we're long-term investors. We are not traders. That's really important. Okay, now Bonnie has a question. Next up, she's from California. Can you please share your thoughts on Microsoft? It's my largest position. I am playing with the house's money. Should I trim it or hold? Well, look, you're playing with the house's money, so the answer is you do not trim. You got to let it run. If only people played that way with Apple and NVIDIA. Think about all the millionaires who be created and didn't have to trade in and trade out. Oh, is this the end of the bull market in NVIDIA? How many times have we heard that? All right, now, what Microsoft, the worry about Microsoft is Copilot is not as robust as people thought. Now, after speaking with Charlie Sharp, again, on the board of Microsoft, CEO of Wells Fargo, you got to understand, do you think that Satya Nadella just sits there and says, you know what, this isn't robust enough? That Amy Hood says, CFO, this isn't good enough? These guys understand. These guys understand that it is got to be perfect. It may not start out as being perfect. I am very excited about Copilot. And I don't think that we should ever think that Microsoft is not a living, breathing organism that says, you know what, I don't know, I guess it's good enough. It's not a good enough like company.
No, definitely. There is a thought more recently that maybe they're losing some of their AI leadership.
Right.
Others are catching up. I'm not so sure. But look, I know Oppenheimer downgraded it last week, concerns that the losses from OpenAI are going to flow through to Microsoft. Remember, they own a 49% stake. And that could be $2 billion to $3 billion. And, there's some current concern about it's what we've heard for like a year with these companies, right? Not getting a return on their CapEx investments because from AI that they're spending on AI, and that's going to hurt margins. Look, we bought some, I think, more recently at 400 when the end carry trade kind of blew up. Maybe on a rally,
Lighten up some.
Yeah, but
No problem.
but for now, just holding on there.
Totally.
All right, so why don't we go to Larry in Texas, who wants to know, is the long-term thesis for Nextracker intact? Really good question. So look, we started buying this because we understood that there's a energy almost shortfall coming, right, because of AI and all of these big mega cap, these cloud companies that are investing so aggressively in data centers. They are committed to renewable power, right? That was the thesis. Unfortunately, they're all going with the nuclear option, right? We saw that with Microsoft, unfortunately for Nextracker. Saw that with Microsoft reopening 3 Mile Island. Saw it today with Amazon announcing a nuclear deal. So that's where they're choosing. So also thought Nextracker would benefit from more from rate cuts. Hasn't happened yet. There's been a few wrinkles. I think election uncertainty is one of them. We've called out policy as one of the big risks when we started buying it. That it'd be very volatile too. So I guess we have to wait till after the election. So the thesis hasn't gone to plan, and it stinks. Obviously, we look at it every single day. But hoping that activity picks up after the election, more rate cuts kind of spurs more action here.
Well said. It's very frustrating. It's funny, it came about because we got an email, a couple emails saying, could you guys go a little more with junior growth, faster growth? And I just kind of did the screen, saw it look good, had the company on several times.
Profitable.
It's profitable.
Technology leadership.
Right. It's not it's not a fly by night.
Yeah. Good balance sheet.
But the company came on and really emphasized the strength of the book of business. And that turned out not to be true. It has the potential for the strength of business to be good. It's funny because Trump is not anti-solar, but it was quite jarring because when it started coming down, I thought for sure that it was all systems go. I didn't know it was a hope stock. And so therefore, it is the only stinker in the garden party of our conference today. All right, next up, we're going to Russell, all the way out in the UK, who asked, big hello from across the pond. I've been following you for almost 20 years now, and you've taught me the word patience and educated me on the U.S. markets. For that, I'm forever grateful, and I am forever thankful. I wanted your take on Coterra. I've held it since $30. What's your advice on adding more of the holding? Well, natural gas is not doing anything. The price is not doing anything. I'm hopeful that when the winter comes, that perhaps it will pick up. But the fact is that you cannot own an oil company when an oil stock, even if it's natural gas oriented, when oil is in the equivalent of free fall. So what I would say in our defense is that we didn't own 3 or 4 of them.
Yeah.
Against us is that you could say, well, listen, if you're willing to own 2 cybersecurity companies, I mean, why didn't you own an oil and a natural gas? And the answer is because I don't like the sector. We bought the one that I think is the least expensive. That's really what my goal is.
I mean, we were in Halliburton for a while, made some money there, during the heyday of oil, 22. But every single time we've bought the Coterra, we've explained it's really just our geopolitical hedge in case tensions rise around the world. We want something that will basically be green in what would otherwise be a big red day.
It's true.
I mean, that's kind of what it is. But look, it's well run. They have a good balance sheet too. You're getting paid a dividend to kind of wait it out. But that's about it. It's a disappointment, to own it, but it's just a hedge. I think we'll just leave it there.
Absolutely true.
All right. Next, we have a question from Bill in New Hampshire who asks, you recommended AMD at 184. So I bought again at 161, then again at 133. Should I be looking to sell at these levels or sit tight? Thank you again for all of your great advice. Well, thank you, Bill. But we just added to our position yesterday, and we wanted to buy after the pullback from the Advancing AI event. It did turn into a little bit of a sell the news event. No new cloud partner. We've gone over the points. A little margin dilutive, but Lisa Su, the CEO, did raise her total addressable market for AI chips over $500 billion. Good roadmap. AI PC should mean more next year. Got caught up in the sell-off yesterday from ASML, but remember, ASML said AI was strong, and I got that same impression when Lisa Su spoke last week. So I don't understand why anyone would think otherwise. So we wouldn't. We're not looking to sell, looking to buy more.
Yeah, I would love to. It comes here, man. Buy.
Yeah.
Okay. Our last question is from Sam in California, who asks, you often speak about owning best of breed stocks. What trust stocks do you consider to be best of breed? Other than Nextracker, they're all best of breed. It has always been my homework to only buy best of breed. I'm less sensitive toward value, less sensitive toward price. Best of breed means no matter what happens in the macro, you don't get hurt. So in other words, we start with a micro, how to value a stock, see what it's valuing versus its other the other companies, typically using PE analysis. All right. And then you go to the macro and you say, how can it do? And the answer is that when you're dealing with Wells Fargo, it's going to be able to deal with whatever, Amazon, whatever, is it AMD, whatever. So we buy best of breed. And when we deviate from best of breed, when we buy a Nextracker, we get crushed. Now you can say Stanley Works is not, Black & Decker is not a great company, but it is the best of breed in tools. You can say that Best Buy is not a great company, but it is the best of breed in appliance retail. So those are small verticals. Those are the ones that I'm most concerned about. But when you stick with best of breed, you don't have a situation where you discover that business isn't as good as you thought, because best of breed companies telegraph correctly and use the quarter as a way to be able to measure their strength and actually enjoy the scrutiny. The other guys don't. So the answer, and it's not hubris, I'm just saying that if you start with the concept of buying best of breed because it means that you're less worried about the macro, you don't lose that best of breed quality when you go through the process and analysis of investing as we do. All right, that wraps up our October meeting.